Hello, everyone. Today, we're diving deep into the 2026 IRS tax brackets, income thresholds, and the newly updated standard deductions. And trust me, this is information that could dramatically impact your wallet this year. Understanding these changes isn't just helpful, it's essential. The way the IRS has adjusted brackets and deductions could alter what you owe, what you keep, and how you plan your finances moving forward. Whether you're a W-2 employee watching your paycheck, a freelancer juggling multiple income streams, a small business owner navigating profits and expenses, or an investor managing dividends and capital gains, these updates affect you. Knowing the exact numbers now gives you the power to make smarter, more strategic decisions that could save you thousands, prevent surprises, and maximize your take-home pay. In this breakdown, we'll cover everything: the new thresholds, how the updated standard deductions can reduce your taxable income, and practical examples of what this looks like for real people. By the end of this, you'll have a crystal clear understanding of how to plan ahead, optimize your finances, and ensure the IRS doesn't take more than it should. This isn't just about taxes. It's about taking control of your money and making 2026 a year where your hard-earned income works for you, not the other way around. The IRS made adjustments to the tax brackets for 2026 to account for inflation and economic shifts. These adjustments weren't arbitrary. Each year, the IRS reviews and shifts bracket thresholds upwards so taxpayers aren't pushed into higher rates simply because prices increased. Tax brackets represent the range of income taxed at specific marginal rates. A marginal rate means only the income within that range is taxed at that rate, not all your income. For instance, if you're a single filer earning $50,000, only the portion that falls into the 12% bracket is taxed at that rate, while the first portion is taxed at 10%. This structure ensures fairness and prevents automatic bracket creep, where inflation alone would push taxpayers into higher rates. The result for many taxpayers is a slightly lower effective tax rate than before, even if their wage didn't change. For 2026, the marginal tax rates remain structured around 7 brackets, stretching from the lowest rate for lower incomes to the highest rate for top earners. The income thresholds for each bracket increased compared to the 2025 tax year. For example, the threshold for the 10% bracket now applies to a slightly broader range of income before reaching 12%. This adjustment may seem small, but for someone earning just above the previous 10% limit, it could mean retaining several hundred extra dollars throughout the year. Similarly, the 24%, 32%, and 35% brackets shifted upward, meaning you can earn more before entering those higher rate categories. Most significantly, the top 37% bracket kicks in at a higher level than before, giving high earners more breathing room before hitting the highest rate. For example, a married couple filing jointly who previously entered the 37% bracket at $720,000 might now see that threshold raised by tens of thousands of dollars, effectively lowering their immediate tax exposure on that upper portion of income. Adjusted bracket thresholds impact your take-home pay, estimated tax planning, and retirement strategies. If you're in a middle bracket, even a small shift can mean hundreds of dollars retained instead of going to taxes. For small business owners and independent contractors who pay quarterly estimated taxes, understanding these updated brackets helps avoid overpaying or underpaying penalties. Imagine a freelance graphic designer who estimates income each quarter. Knowing the exact thresholds allows them to calculate accurate payments and reduce cash flow surprises. The IRS also updated the standard deduction for 2026. The standard deduction is the flat amount the IRS allows you to subtract from your taxable income if you don't itemize deductions like mortgage interest, charitable contributions, or state taxes. The increase in the standard deduction means many taxpayers will find it more advantageous to take the standard deduction rather than itemizing, especially if deductions are close to the new threshold. For single filers, the deduction increased by several $100s. Married couples filing jointly see an even larger jump. Head of household filers also received a modest increase. For example, a married couple who used to deduct $27,700 as a standard deduction in 2025 might see that number increase to nearly $29,000, directly lowering taxable income and potentially reducing tax bracket exposure. This adjustment is particularly meaningful for middle-income households, retirees, and young professionals starting out, as it automatically reduces their taxable income without requiring detailed record-keeping. For retirees or those with Social Security income, the adjusted brackets and standard deduction can influence how much of your Social Security benefits become taxable. If your combined income moves into a higher bracket due to these threshold changes, more of your benefits could be taxed. However, for moderate-income retirees, the higher standard deduction means more income remains non-taxable. Consider a retired couple receiving $25,000 from Social Security and $20,000 from part-time work or investments. Previously, a portion of their benefits may have been taxed, but with the 2026 adjustments, more of that Social Security income could remain tax-free, effectively increasing their disposable income for living expenses. Some taxpayers will see the impact in withholding adjustments. Employers use the IRS guidelines to determine how much tax to withhold from your paycheck. With the updated brackets and standard deduction, your employer can adjust your W-4 withholding so you keep more money throughout the year rather than waiting for a refund after filing. It's worth reviewing your W-4 early in the year or after major life changes like marriage, a new job, or a child's birth. For example, a parent who welcomed a newborn in 2025 may want to increase withholding allowances to match changes in deductions and credits, resulting in more consistent monthly cash flow. There are implications for tax credits as well. Credits like the Earned Income Tax Credit, Child Tax Credit, and Education credits interact with your taxable income. When the bracket thresholds and standard deduction increase, the phase-out ranges for these credits may shift effectively. That can result in larger refund amounts or reduced liability, depending on your specific financial situation. Families with school-aged children or college students may see meaningful differences in their credit eligibility. A couple previously receiving a partial child tax credit could qualify for a full credit under the new 2026 thresholds, potentially adding thousands to their refund. For business owners, these changes influence estimated tax payments and retirement planning. If bracket thresholds shift upward, you might revise quarterly payments to balance cash flow without increasing your tax liability. Maximizing retirement contributions to accounts like a 401 or IRA remains a strong strategy to reduce taxable income. Because bracket thresholds rose, contributing maximum funds into tax-deferred accounts may now push you into a more favorable effective tax rate. A small business owner contributing the maximum to a SEP IRA can lower taxable income substantially, while still benefiting from the raised thresholds, resulting in a double advantage. Investors need to consider capital gains and qualified dividends. These are taxed according to separate rate schedules, but are tied to income thresholds. Because those thresholds increased, taxpayers might qualify for lower capital gains rates on a larger portion of their investment income. Strategic selling of stocks, mutual funds, or real estate within these thresholds can reduce tax on gains if timed well. For example, a taxpayer with $15,000 in long-term gains may previously have been partially taxed at 15%, but under the 2026 thresholds, more of that income may be taxed at 0% or 15%, depending on overall income. If you receive non-wage income, such as rental income, royalties, or gig earnings, your total taxable income may place you in different brackets than previous years. Because self-employment taxes and income taxes are separate, planning ahead matters. Increasing contributions to health savings accounts, or SEP IRAs, helps lower taxable income and takes advantage of the updated brackets to keep your effective rate lower. A gig worker earning $60,000 from freelance work might use HSA contributions to reduce taxable income, keeping them in a more favorable bracket while also saving for healthcare expenses. High earners should pay attention to the applicability of additional levies, such as the net investment income tax and the additional Medicare tax. Thresholds for these taxes aren't indexed the same way as regular tax brackets, so understanding where your income lands after these adjustments is critical. For someone earning $250,000 plus individually, a few $1,000s in salary or investment income could trigger these additional taxes. Planning the timing of income or deductions can mitigate these extra liabilities. Tax planning tools like tax software or consulting with a certified tax professional become even more valuable with annual changes. A tax pro can help you analyze not just your 2026 liability, but how changes affect your multi-year financial plan. For families, this includes educational savings plans like 529 accounts, childcare credits, and other age-related considerations that interface with taxable income. A financial planner can run scenarios showing how adjusting retirement contributions or timing bonuses can impact both taxes owed and long-term savings growth. The IRS also regularly updates inflation adjustments to retirement contribution limits. While separate from the tax brackets and standard deduction, these changes often accompany updates to thresholds. Increasing limits on 401, IRA, and Roth IRA contributions allow more sheltering of income from taxes. For people maximizing retirement contributions, it's even more reason to review your financial planning for the year. For instance, a taxpayer contributing the maximum to a 401 may now be able to contribute an additional $500 to $1,000 due to increased limits, directly reducing taxable income while preparing for retirement. To use the updated brackets effectively, start by estimating your 2026 taxable income. Subtract the new standard deduction or your itemized deductions. Then apply the bracket thresholds to see where your income falls. This analysis gives you a realistic view of your tax burden. From there, look for opportunities to reduce taxable income, such as maximizing retirement or HSA contributions, and evaluate timing of income and deductions. For example, if you expect a large bonus late in 2026, delaying income or accelerating deductions could prevent a jump into a higher marginal bracket. While many taxpayers could benefit from the higher thresholds and larger standard deduction, every situation is unique. Life events like home purchases, major medical expenses, job changes, marriage, or having children dramatically shape your tax outcome. Being proactive rather than reactive with planning often results in better financial outcomes. Even small steps, such as timing charitable contributions or business expenses, can add up to hundreds or thousands of dollars saved over the year. This year's IRS adjustments reflect an ongoing effort to balance tax fairness with inflation realities. For millions of Americans, the updated brackets could mean smaller tax bills or at least a smaller increase in liability compared to years where no inflation adjustments occur. Whether you prepare taxes yourself or with help, take time to review the official IRS tables and updates for 2026 before filing. These changes are not just numbers on a page. They can affect your cash flow, saving strategy, and long-term financial well-being. Reviewing them with your personal financial goals in mind is the smartest approach. By understanding these shifts, you can optimize withholding, maximize deductions and credits, plan retirement contributions, and strategically time income to keep more money in your pocket throughout the year. Remember, these adjustments apply to more than just federal income tax. They can influence decisions for state taxes, investment strategies, and even financial aid eligibility. For example, a family planning college expenses may benefit from understanding adjusted income for federal purposes since this affects expected family contribution calculations. Similarly, taxpayers planning to sell property or diversify investments should consider how raised thresholds affect capital gains exposure. Being aware of these changes empowers you to make informed choices rather than reacting at tax time. The IRS updates for 2026 are designed to provide relief from inflation, adjusting brackets and deductions to better reflect the current economic landscape. But while these changes offer a baseline of financial relief, the real advantage comes from proactive planning. Simply knowing the numbers isn't enough. What truly matters is how you use this information to make smarter, more strategic financial decisions throughout the year. One of the most immediate ways to take advantage of these updates is by reviewing and adjusting your W-4 with your employer. Ensuring your withholding accurately reflects your expected tax liability can prevent unpleasant surprises when tax season arrives. If too much is withheld, you're essentially giving the government an interest-free loan. If too little is withheld, you risk underpayment penalties and a large tax bill at the end of the year. By aligning your W-4 with the updated brackets, you can better manage cash flow, maximize your take-home pay, and even free up money each month for investments or savings. Retirement planning is another critical area where these changes can be leveraged. Contributions to tax-advantaged accounts, such as 401, IRAs, or Roth IRAs not only support long-term wealth building, but also interact directly with the new tax brackets. For instance, contributing pre-tax dollars to a traditional 401 reduces your taxable income, potentially keeping you in a lower bracket and lowering your overall tax burden. Even small increases in contributions can have a meaningful impact on your tax bill while simultaneously growing your retirement nest egg. Deductions and credits have also been subtly adjusted, and understanding them is key to optimizing your financial strategy. Whether it's tracking charitable contributions, mortgage interest, or state and local taxes, effectively managing these deductions can reduce taxable income and increase refunds. Tax planning isn't just about avoiding overpayment. It's about strategically managing every possible deduction and credit to support your broader financial goals. Investments are another area where timing and planning can make a significant difference. Capital gains, dividends, and other investment income are impacted by bracket thresholds. Being aware of the new brackets allows investors to strategically plan sales, harvest losses, or time income recognition to minimize tax liabilities. Even small adjustments can translate into hundreds or thousands of dollars saved each year, directly affecting your ability to reinvest and grow wealth. Beyond individual tactics, the broader benefit of understanding these updates is the peace of mind that comes with financial clarity. Knowing exactly how your income interacts with the 2026 tax brackets allows you to plan for the future with confidence, rather than reacting to surprises when tax season arrives. Ultimately, these IRS updates are more than just numbers on a page. They are tools to help you retain more of your hard-earned income, save effectively, and invest in your future. By taking the time now to understand these 2026 tax bracket changes, you position yourself to make smart decisions that go beyond just this tax year. You're building habits that support long-term financial stability, wealth accumulation, and the ability to achieve major life goals, whether that's buying a home, funding education, or planning for a secure retirement. Proactive tax planning, informed by these updates, empowers you to act rather than react. It allows you to make tactical moves, protect your earnings, and take advantage of every opportunity the tax code offers. The result is more than just lower taxes. It's a stronger financial foundation, better money management, and a clear roadmap for achieving your financial ambitions. In 2026, staying informed and acting strategically can turn what might seem like complex tax rules into a powerful advantage, ensuring that every dollar you earn works harder for you.